So how are you doing? This is David W. Williams, also known as Diamond Dave. And what we're going to talk about today is how to see the trade. And what I'm going to do is I'm going to try to give you my own kind of breakdown of this particular situation. And I'm going to try to show you what I normally do when I'm looking at a ticker and some of the things that I go through. And you don't have to copy this. Just because you do exactly what I do doesn't mean you're going to be successful. Hopefully, you can kind of take some of what I do and implement it into your situation, and you can get some value and get some benefit from it, right? And what I'm doing is what I teach people, right, in my particular course called www.thehighestpaid.online is an options trading academy. I guarantee you the prices will be going up at the end of this particular month. We're still adding some content in before we make that price change, but we will be changing the price for 2023. And we want to kind of get you to understand. So based on how I instruct here is you're going to kind of see a similarity of this over and over and over and over again throughout the course. So you can kind of look at this video, and if you have the attention span, you'll be able to sit through the whole video and kind of understand what I got going on, what I'm doing, and kind of how I look at tickers, right? And so hopefully you can take something from this that'll be beneficial to you. If not, apologize for going through this whole process, but I'm hoping that I can give you some value because I think that the way I look at situations is a little bit different than what a lot of other people do, which is why I've been able to have so much success in the market without having $20 million behind my name and without me getting paid with assets under management. I primarily get paid as a performance trader, the way if I don't perform in the market, I don't make any money, as opposed to somebody that gets paid to drive people into their particular fund, and they just get paid on the pool of capital that they manage, right? So I'm coming from a little bit of a different perspective. But enough about me. Let's get right into it. So what we're looking at is Ford right now. To give you a heads up, I don't necessarily trade Ford. All right. I was talking about Ford with somebody that's in my particular program yesterday, and we were talking about some of the things going on in Ford. I said, well, let me go ahead and just show people what I normally do when I look at a ticker. And they could kind of maybe take some from it and, kind of apply it to their situation, right? So we're talking about Ford, which is the automobile manufacturer. They're a legacy player. They've been around a long time in this particular country. And if you have any questions, let me know. So what's going on, Dr. Chaz? I'm going to email you about something. Miss Phoenix 91 and then Julian Brown, what's going on? So appreciate everybody for coming through it. And if you are, let me know what part of the country you're in and let me know that you can actually hear me, right? So let's keep going. So first thing I'm going to do, right? I'm going to do a 5-year view, a 2-year view, and a 1-year view. That's what I'm going to do off the top. And I'm going to also do something else too. But off the top, that's the first thing I'm going to do, right? So let's go to the ticker. I'm going to just go 5 years. And I'm just trying to figure out on a 5-year view, like what does it look like? So we're looking at the weekly candles on a 5-year view. And I'm just looking at where the peaks are going to be at. Where did it peak at? Where did it bottom off at? We see that on a 5-year view, it pretty much bottomed off around the pandemic. But we see on a 5-year view, the support was really heavily in the 10 to 11, maybe the 10 to 11 to $12 area. A lot of trading range between there and also between that $7.50 and $10. Then right after that, it hit a real low around the pandemic, under $5, and then it worked its way back up. So the biggest growth was between the pandemic and 2022, right? This is the biggest growth because it was at 5, really at 425. And it got all the way up to 24. So this was really the time to be in the deal, right? And then we see they discontinue dividends. So they paid a dividend out of 1/9/2020, and they discontinued the dividend. That thing didn't get paid out again until 11/18/2021. And I remember when they discontinued the dividend, and that's why they had a lot of selling, because one of the reasons why people was in this deal is because it paid out a dividend. Now I'm going to just go to a 2-year view, right? I'm going to look at the same thing, right? So over 2 years, kind of what does it look like, right? And I'm just trying to get a basic grasp of the ticker, right? I haven't really started looking at anything yet. I'm just trying to get a basic grasp of the ticker, just see what I'm looking at, right? Let me get rid of this banner real quick, okay? Just get a basic grasp of the ticker, right? Let me get that out of there. Just get a basic grasp of the ticker, see what I'm looking at with this particular ticker. Then I'm going to do the same thing on a 1-year view, okay? And all I'm trying to do is just see what I'm looking at. Just get a basic lay of the land up with this ticker. I'm on the 1-day candles. I cannot change this to the weeklies on the 1 year, right? Where's the weekly close at? I can also change it to the monthly, right? And just get a basic layout. just try to understand, like, what am I looking at? If you look at the monthly candles, uh, since the top of the year, since the top of last year, uh, monthly candles was really, really bearish. Then it consolidated pretty much right at this support on the monthly. So these are the type of things that you see if you start looking at it from a longer term view and you're looking at it from different time spans. So it's very interesting that on the monthly candle, we get a lot of consolidation around this support on the monthly. So as a trader, that kind of tells me something, that even though we get a lot of volatility in between the 30-day period, the open and the close is always within a particular support level. Then another thing I do off the top is I look at the options chain, right? Because I want to see, before I start any research, one, what is the volumes on the chain, right? What are the volumes on the chain? What is the IV on the chain? Is it liquid? Is it not liquid? Are the spreads really tight? I want to look at things of that nature, because if the chain isn't any good, I can't buy options on it anyway. Because what I don't want to do is be on a liquid chain. And what I mean by in a liquid chain is, I mean a chain it doesn't have a lot of liquidity, where I can't get in and out of the contracts the way I want to. Because then what that does is it brings in a lot more risk. So I can look at a ticker, know what I'm looking at, have a really good narrative on where I think the ticker's going. But the options chain is so thin, I can't play it, because what it does is it increases the amount of risk on the chain, right? And so what I try to do is put myself in the best position to be successful based on having all these things in my favor first, because I can't predict where the market is going to go, but I can dictate whether or not I buy a contract, because the options chain is very illiquid. And then if I get stuck in a chain that's very illiquid, then it means I can't get out of the play when I want to, which means that if I'm wrong, I could take a big haircut trying to get out. And if I'm right, I may still have to take a haircut just to get out of the position. So as a trader, that applies to every market. So we're going to give you some insight to any market. You don't want to put your money in any illiquid market. It doesn't matter what the market is. So it's not just about the options market. A lot of the principles as a trader apply to every market. So this is why it's dangerous for us to learn this information, because we can apply this to every situation. So you won't go for, right, I'm going to put my money in an illiquid market, because you realize if the market is illiquid and I want to get out, I can't get out. It doesn't matter what the market is. It's the same principle regardless of the market. So yes, there could be a potential for an upside, but even if I get the upside, but the market is illiquid, I still can't get out at the price I want to get out at. So it means it may not be a good investment based on my risk parameter, right? So these are the first things I look at. If the options chain, if I don't like how it looks, I don't buy it. I was looking at contracts on, it's a software company called NOW, I believe. ServiceNow, I believe the name of the company. I believe that they're going to sell off after earnings, but I couldn't find good options on it, right? So because I believe that they're going to sell off after earnings, and I'm fairly confident that they will, but the options chain isn't there, it means it's too risky for me to try to buy an illiquid contract, right? It's just too risky. I couldn't find anything on the chain. So those are the first two things I'm going to look at before I do anything else. So if the chart kind of somewhat makes sense, there's enough volume on the ticker. So here's something else I look at. The volume on the ticker, okay? If we're looking at tickers that are under 1 million in volume, you got to be worried about that, because again, you don't have a lot of liquidity, right? So you, as a person that's involved in the markets, you do not want to put your money in an illiquid market. That's one of the worst things you can do. Not investment advice, my opinion only. But a lot of people that don't trade don't know this, because they don't have to worry about it, because they only know about, only allowed to participate in liquid markets. But there are illiquid markets you can participate in. I was reading an article about how investment advisors are telling their clients, because the S&P has been down so much over the past 2 years, to put your money in a lot of private holdings, right? The problem is that those particular private holdings are illiquid. So then therefore, when you look to get your money out, you can't, because there's no market, right? So this is all the preliminary work I'm doing way ahead of time. So I've been very right on tickers before, but the market was illiquid, right? I know a guy that's very bullish on WD-40, right? It doesn't matter, because WD-40 is illiquid. The market for their shares is not very liquid. So even though he's right, you can short sell it if you want to. The question is, when you go to sell those shares back into the market, you may not be able to get the price that you want because it's not a very liquid market. The market is not very robust for those shares. And so these are the things I got to look at. So Ford has a very, very liquid market. It does 49 million in volume today. It's a little bit under the average. The average is 54 million in volume every day. So we're talking about a very, very liquid market for these particular shares, right? So this means that I shouldn't have a trouble getting in and out of this market. So this is just a basic preliminary work, okay? Now, what I'm also going to look at is the earnings the past few quarters, right? Because I want to just get an understanding of how this company is performing. So on Yahoo, you can do that relatively easy because we have the earnings right here. So we see here they missed big, right? In 2021, they missed Q4. They hit it pretty much. They say they beat it by 1 cent. They outperformed it here, right? They beat it by 23 cents. They barely beat it here by 0.03. And then now we have this getting ready to come up in February, I'll say the 2nd, right? 0.60 to 0.65, so right in the middle. I just want to know how have they performed the last few earnings, because what it's really telling me is that what's the state of the company and what's the state of management, because it's the job of management to hit their earnings projections. So let's say that you say in your business, we're going to make $100,000 this year, right? And you're running the business. It's your job as that business owner, right, to hit that every year. As the operator of that business, it's your job to hit it. If you're not hitting your earnings projections, you as a manager of the business are at fault. And no business, you should not operate a business without earnings projections, because then what are you doing? Right? What are you doing every year? So, you know, successful businesses can make projections and either hit them and get close or not hit them, and they have a justification for why they didn't hit them. So these are the things I'm looking at from a management standpoint. Are they hitting their earnings projections, right? And then as I get deeper into the understanding the company, then I start asking myself, based on their next earnings, which is right here, do I think they can hit it? Another place you can look at it is you just go to NASDAQ, right? So this is NASDAQ.com. Look up Ford, and I can go to their earnings page. And then I can see with a bar chart, what was their earnings, right? So here's estimated 0.43. They hit 0.68, estimated 0.31, they hit 0.3, estimated 0.59. See whether or not they hit it with a bar chart. We hit right here, we have it in actual numbers, right, where they hit it. We have the yearly earnings forecast. Then we have their quarterly earnings forecast for December 2022, which is going to be this quarter that we're going out of, that we're now in 2023. So they're reporting on a lagging date. It's at 0.59. This is the high forecast of 0.64. This is the lower 0.56. Right? So we have it as a lower 0.56. If they go probably 0.56 or under, that's a big earnings miss. If they hit 0.60 or over, that could be a big earnings hit, but you also got to look at revenue, right? Also, I can go to Seeking Alpha. I can see their last earnings for Ford, right? And then we can kind of see same thing, bar chart, what their annual earnings estimate is, annual revenue, earnings history. Some of this information they're going to want you to pay for, but some of it's free. So you have multiple platforms where you can look up their earnings and try to understand. And also, worst comes to worst, you just go into their investors page. So Ford has an investors page because they're a publicly owned company. You can go into that investors page, and then worst comes to worst, you can go to the SEC and you can look up their SEC documents, because they have to publish those documents as part of being a publicly owned company by law, or either by SEC regulations. They have to publish their financials. So the information is available to you. It's just where you're going to look to find it at, right? You just got to be willing to put the work in, right? And over time, it'll get a lot easier for you to sift through this information. So I look at earnings the past few quarters. What I want to find is, did they hit it? Did they not hit it? What is their earnings coming up into this next quarter? Because that's going to all add into my particular analysis, right? So I do all of this before I even look at trying to get options on the play, right? Then I listen to earnings for the past few quarters. So I listen to their last earnings, and I listen to probably their earnings before that, minimum. And these are things you can do. Seeking Alpha normally for that company page will have the earnings call, the last earnings call there. It'll be in the archive, right? So you can listen to it from Seeking Alpha. You can listen to it from the investors page. Sometimes it's even on YouTube. It's a really popular ticker. So there's multiple opportunities for you to listen to the earnings, right? Because I want to understand, what are they communicating to me, right? Because my question is, what direction do I think the company's going? Right? So based on their earnings, based on their chart, whether or not they're hitting their earnings, what direction do I think the company is going? These are the questions I want to ask myself, right? And then the next question is that direction in contrast to the industry that the company's in? So what I mean by that is that, let's say Ford says, we are not going to really pursue EV. We're going to just stay with internal combustion engines. We don't see a lot of value in pursuing the EV space, where that normally will be in contrast to where the rest of the industry is going. So that's with any company in the industry. Like, what is the industry or the sector trend? And is that company in line with that? And it doesn't mean it's a positive or a negative. It's just, I just want to know, right? Are they in line with where the rest of the industry is going, or are they opposite? Because some people may make their money being opposite, right? So you just got to always ask yourself these questions, right? What direction is the direction in contrast to national policy? We're looking at Ford, they're an EV player. We know that part of our national policy is to deal with climate change. As part of that national policy of dealing with climate change, we have a lot of campaigns based around climate change initiatives. As part of those campaigns, we have initiatives based around electrical vehicles or alternative energy vehicles, right? So Ford's direction is in line with the national policy, right? That's in line with it, right? Because they're pushing more into the EV space. Now, they haven't totally phased out their internal combustion engines. They haven't really, from my understanding, they haven't talked about it, but they may have, and I missed it because I'm not really deep into this company. But from what I understand, with their EV rollout, it is in line with national policy as opposed to being in contrast to national policy. And so this is why I tell people all the time, there is no such thing as a successful business that doesn't have some type of alignment with government, right? It doesn't exist that way. Because if government wants to, they can create an environment to where you can't do business. And you see that if you go to other parts of the world. And that's why it's so difficult for to get business done in other parts of the world. Like if maybe you go to the continent of Africa, maybe go to Central South America, because it can be hard to get government to be on board with your business. It's not because people are better business people over there or here than they are over there. It's that our government is in line with business. So they create tax incentives. They give taxpayer incentives, which means they give tax dollars to businesses to do business with consumers. So it's weird. We take money from consumers to give to businesses so they can do business with consumers. But people believe that, well, these businesses work because they're just geniuses. No, they take our money to do business with us. Right? Well, if you go to the Gambia or you go to Zimbabwe, the government may not give you business to do business with the people in Zimbabwe. So you got a lot farther road to climb to be a successful business. In America, we do these type of things, right? So you got to understand like what's going on in the space and how is the national policy, how is that in line with what they're trying to do, right? And so you want to kind of understand, because that's how you can try to figure out what direction this company is going. Does the company lead its market in anything, right? So that's the biggest question you want to ask, because when I'm looking at a company, I want to know who's the market leader, right? And am I going to define that by sales, whatever, but what's the market leader, okay? Because as a marketer, one of the things that we learned is that if you can't be first or second in your market, you have to create a new market. If Ford is going to push very heavily in this EV space, are they doing it because they're trying to be the market leader? Or are they just rolling out an EV car just to say they got an EV car? And these are the questions you want to ask yourself. So does Ford lead the market in anything? So I was talking to somebody yesterday, and we were talking about, like, we believe Ford leads the market in a certain truck. They sell a lot of trucks, so they probably lead the market in selling this truck. So does a company lead the market in anything? Because that can impact how people perceive that company, because they're a winner in that particular space. And looking at this particular company to where they have, to me, a very diverse offering, they don't sell like one car, then the question is, what do they lead the market in? And if they don't lead the market, then where are they in the market, right? Next question, who's going to be the number one competitor for this company and why, right? So if they lead the market, who's the number one competitor? So who's number two in the market for what they do, right? Because everybody doesn't do the same thing. And then I wouldn't compare Ford and Rivian, because Rivian wants to be a luxury truck maker. And I don't know if Ford is trying to be a luxury truck maker. I think Ford is just trying to put out a truck. But Rivian has positioned themselves as a luxury truck maker, like Luce is positioning himself as a luxury EV car. right? So who's going to be their number one competitor? Is it going to be Tesla? Is it going to be Toyota? Is it going to be Porsche? Is it going to be Volkswagen? For what I think Ford's going to lead in, who's going to be their number one competitor? So Ford's going to lead in, we're going to be, I don't know, the leading EV truck maker, right? In the mid-tier space. So they're not going to do luxury. They're not going to do discount. We're going to do mid-tier. Okay, who's going to be their number one competitor? Because what we're seeing with Tesla is one of the reasons why they're dropping their prices, in my opinion, is because they want to compete at a different price point than what they were at before, because Teslas used to be really, really expensive. When I first moved to Atlanta, I was playing in a basketball league. That guy had that Tesla with the Gulf wing doors, the red one. That was a much more expensive car than the ones they're currently selling right now, because Tesla didn't have economies of scale. I'm going to talk about that later on another video, right? So who's the number one competitor? Next question, can the management team get the job done? So who is the management team? Can they get the job done? And I can kind of understand that by listening to earnings calls. What are they talking about they're going to do? Have they done it? So if I listen to the previous earnings call and then I'm looking at how they performed this quarter, did they do what they said they was going to do? Right? You got to understand, like, who's the managing the company? Okay. Do they have a track record of such? The people that are managing the company, do they have a track record of getting the job done? Because sometimes you can look at companies and their managers are people that go from company to company to company to company. They never get the job done. And so that's immediately give you suspicion with that company. And I've seen this with certain, especially pharmaceutical brands, right? The manager or the CEO goes from company to company to company to company. They never get the job done. Well, that's an immediate short, because I know that this is a pump and dump scheme, because this manager has a history of going from company to company to company, and they never accomplish the goal. And there's always something going on with that company, which causes a massive sell-off in the stock. And then next thing you know, 2 years later, they pop up at another company, right? Anybody you're looking at that's managing a company should have a track record. Where did they come from? And what were they doing before they got to this company? Do they have a track record of getting the job done in any area as a justification for why they're currently here right now, right? Next thing, what are some of the quirks around the company, right? So one of the quirks around Ford is that the family descendants are living off the dividend, right? So what are some of the quirks around the company that we're looking at? Is it the management? Is it that they have a particular competitive advantage? Is it where they're currently at in the country? What are some of the quirks around it? You know, if I'm looking at a EV company in China, one of the quirks would be that they're going to be very beholden to what the Communist Party wants them to do. So that can put a lot of risk in that company. Also, what's a quirk around the company? You're investing in a Chinese company, which means you don't own anything, because your investment is really being held in a shell company probably in the Cayman Islands, because it's illegal for a foreigner to own anything in China. That's a quirk. So you really don't. So that's a risk that I got to factor into it, because you could wake up tomorrow and they could just say, well, you don't own anything. And what are you going to do? Go to China and sue them? You can't do anything. So anytime I'm looking at a company, I'm looking at what are the quirks. I'm looking at Tesla. What is one of the quirks? The CEO is very active on social media. That can impact the share price. He's in court. You got to testify on Friday behind stuff that he's done on social media. That's a quirk. With other CEOs, you don't have to worry about that. So these are the things that can impact the stock price. It can boost it up. It can bring it down. These are some of the quirks around the company. These are the things that I want to know, right? Next thing, if Ford doesn't pay a dividend, why own the stock, right? So I'm looking at a dividend stock, but it's not a growth stock, right? So we talked about before, going back to the chart, we can show the dividend payouts. If they don't pay a dividend, let me go to the 5-year. If they don't pay a dividend, why own the stock? Right? Why own it? So these are the kind of questions you want to ask. What is the value of this stock if it's not a dividend? Because part of their appeal is they pay out every quarter, I guess. And you can go on Yahoo and look at what their dividend payout is. Can they support the dividend? So the question is, you know, why own this if they don't pay a dividend? Is it because that their prospects for the future is so great that I can justify it based on the growth of the company, right? Because Ford has been around before any of us have been born, so they're probably out of their growth stage. So I may not get a lot of appreciation on the share value. So then the only reason I would own this is because they're paying me to own it, because I'm not going to get a lot of appreciation on the share value. Okay. So these are the kind of questions. So I know that if Ford ever comes out and was like, well, we're going to get rid of the dividend, that's it. Because you're not buying into a growth play. The growth is no longer there, even though they're trying to add on this EV. Most likely they're going to sell EV to the same people that was buying their cars before. I don't know, unless they figure they have some type of appeal to their EV vehicle that's going to bring in new demand. And this is what I will find out by studying the company. What is going to be their EV offering? What about that truck is different than the Rivian? What about that truck's different than the Cybertruck? Yada, yada, yada. Are they going to be price comparable? Because does Ford have the ability to take people that were going to buy the Rivian and buy the Tesla and drive them over to Ford because of the value of their particular offer? So these are the kind of things I would ask before I ever ran a trade on the ticker. Then I'm going to go into float size, right? So let me go here to the statistics, right? And I'm going to kind of give you an impression of why I think that's important. So let me see, can I zoom this up a little bit? Right? So float size, okay? Float size is 3.94 billion. Okay, that's a big float in comparison to the daily shares that traded on the daily. Right? That's a big float. Right? They printed out a lot of shares. What that can do though is mean that it can be hard to move this ticker because of the float size in comparison to how many shares are traded on the daily. When I say move it, I mean move it with a lot of volatility. Now, I would probably look up the stock volatility, but just looking at the float size, it can be difficult to really move the ticker the way I may want to see it moved. Also can look at percentage of the float that's shorted. It's only 3%, which is nothing in comparison to the float size, right? That's very low in comparison to the float size. Institutional management, 52%, right? It's not great. It's not bad. But one thing you want to understand with 52% institutional holding, there's probably going to be a floor where if Ford starts to sell off, there's going to be automatic buy orders, right, to buy it up. So my bad, I forgot about institutional ownership. So if Ford starts to sell off, there's probably going to be automatic buy orders. And that's why you may see their support, why you see that support line being so strong, is because there could be automatic buy orders there to where they've already said, we will continue to accumulate Ford at this price if people start to sell it because of our long-term view on Ford. Because if Ford holds a price and pays a dividend, it's like a piggy bank that pays a dividend, right? So this is why I want you to start looking at the market differently. If Ford can hold a price and pay a dividend, it's like a piggy bank, right? So I don't know what the the dividend percentage is, but if I have $10 million and I can buy Ford at, let's say, $12, I can buy it at 12, and over the next 4 years, it's going to pay me a dividend, right? That's going to be higher than what I could get paid holding a treasury, which is risk-free, right? It may be worth my while to put the 10 million in. You understand me? So this is why when we don't really understand these markets, we just be talking on the internet, right? Because if I don't know what the risk-free rate is, I don't never need to be talking about it. I'm not talking about people watching it personally. I'm just trying to give you a broader scope of how capital thinks. The risk-free rate is 4% over 4 years. And I can put my money in Ford and get back greater than that over 4 years because of the dividend payout. It may be worth the risk if I believe that it can support that $12 price. Because even if it goes lower, it still may pay out the same dividend. The problem is I don't get appreciation, right? It's a bonus if I can buy in at 12, get paid 4 years at a certain percentage greater than the risk-free rate of 4 years, and then exit at 25% greater. See? So when we just think the only way to get a return is to just index your money, then you just get that. But the index is not risk-free. There's a level of risk with the index. If you want to get a risk-free, just buy treasuries because you're guaranteed to get the percentage. Everything else is up in the air, right? So you got to really understand, when we don't understand these markets, we're beholden to other people and what they decide to tell us at that time because we don't know where we're putting our money, right? So we really putting our money in a magic black hole and hoping it spits out a return. right? And when you don't know how to talk to people a certain way, they know that's your expectation, right? So I know that that institutional ownership can give me a price floor. And as shares start to get lower, they'll eat up the shares because they have buy orders already in there. And unless something fundamental happens to forward or fundamental happens in the world, like the pandemic. So if we get another pandemic, well, all bets are off anyway across all markets. So it don't matter anyway, right? So if we get another pandemic, all bets are off anyway. So it don't matter. Everything has to be rebuilt from scratch. So these are the kind of things that you want to look at because that can impact the share price of this particular ticker, right? So if Ford comes out tomorrow and says we no longer going to pay the dividend, I would expect a massive sell-off. Why? Because why do I own this if they don't pay a dividend? Because most of the people that are owning Ford are looking to get a return on their investment greater than the risk-free rate. That's the only reason they're in this deal. There's no other reason to be here. There's no growth here. This company's been around before we was born. So all the growth is gone. They're like U.S. Steel. Okay? Where's the debt? When the debt needs to be paid back. How much debt is in this deal? And can I look to their financials and find out when this debt is going to be due? And do they have the ability to pay the debt back? Right? So the debt is, I got it 129.76 billion. Right? They got cash of 31 billion in the bank, which means that if they took that cash and paid off all the debt, they still would have around 100 billion worth of debt. My question is, when is the debt due? And can they push the debt off into the future? And what is the debt in relationship to the current assets? Right? Because the question is, can they support the dividend? Because it's the only reason people is in this deal, in my opinion, is because of the dividend. No other reason to be in this deal. Operating cash flow, levered cash flow positive, which means that there's money left over after they do operations. Return on assets, return on equity is positive. Margins are low, but margins are low in the car space. So when I'm looking at margins on a company, I'm comparing it to the actual industry, right? There's not a lot of margin in selling cars unless you do a boutique line. If you got a scaled out operation like Ford or Toyota or Honda, there's not a lot of money in the car business, right? It's a very cash intensive business. And there's just not a lot of margin there. That's why when you go buy a car from the dealer, they don't make money on the car. They make money on all that other stuff they sell you. Now, the last 2 years, they've been making money on cars because people have been paying over MSRP, which to me is ridiculous. Once we go back to our normal environment, they don't make money on selling that car. They make money on all those add-ons. That's where the margin's at. The margin's not on buying the car, right? So when we're looking at the overall car industry, a lot of times the margins are not what I really call robust. I was an econ business management major in college, so 2 majors. One of the things that my management professor told us is that if you can't get around 20% margin, you're wasting your time. But that's going to be industry specific, right? Some businesses will never get a 20% margin, like grocery. It just won't happen. So you got to always compare that to other players in your industry. Tesla's margins are a lot higher, but they're not selling the number of cars that Ford or Toyota or Honda sells. As they start to ramp up numbers of cars sold, that margin is going to come down, which means the growth is going to be gone, right? Because even with economies of scale, you can't sell X million of cars per year at a 20% margin. Because you're no longer a boutique line, now you're a volume baseline. So that's something I want to look at, margin, right? So how well is the company being managed from a financial standpoint, right? These are things I want to look at. So let me see what the next one is. Let me go here. We talked about cash in the company. We already talked about that. Is a company in a growth stage. So if I believe that Ford was in a growth stage, we can overlook some of the margins not being great because they're in a growth stage, they're going to burn up a lot of capital to try to accelerate growth. And that's normal in the growth stage. The problem is that they have to justify that by continuing to grow, which means what? We have to be able to create more demand and make more sales. So if I'm in a growth stage and we're projecting sales to increase by 15% next quarter, and then during that quarter we report and sales only increased by 10%, what does it mean? Growth might be over. So I'm in this deal because it's a growth deal. If I feel that growth is over, then this thing is now mispriced because it's been priced for growth, right? Because the stock market is a discounting mechanism. So the current price is where we think the price should be in 6 to 12 months, right? And so a lot of companies are priced so far out into the future based on their growth projections. Once they miss those growth projections, we got to reset that. That's what you saw with Zoom about a year ago. Well, once they no longer can bring in new customers, they had to get repriced, which is why they was like $600 at one time. Now they trading around $100. And they lost all that value in the course of a year. Right. And I was talking to Chastity about it. And I said, unless they add a new product to what they're doing and try to figure out how to find some new customers, it's over for them, because everybody that's going to get Zoom already got it. There's nobody new that you can sell it to. So where does the new demand come from to justify the growth narrative? It didn't exist. They hit a demand wall, which means that we've mispriced this because it got priced for growth. Once you start to stay in this market long enough, you'll see plays like that coming a mile away. Right? Once they price something for growth and they can't support it, it's over for them because it's been priced for growth. Right? So you got to understand, like, what stage a company's in, how the market is going to perceive it, because we're not talking about Ford as a growth ticker. It's more of an institutional ticker that's just trying to maintain themselves so they can keep paying out this dividend, right? It's just, I would say people are using this as a way to put their money to get a return greater than the risk-free rate, right? If it's a stable company, how does it attract new capital? We're going to have a video. I'll probably explain to you the real reason why companies go public. Some people know, they've been hanging around me long enough based on my perspective. The average person has no idea, right? So if we're a stable company, we're no longer in a growth stage. How do I attract new capital? Is it by sales, right? Because most growth companies are doing some type of equity raise, right? But I'm not a growth company, so how do I bring new capital into the company? I got to keep driving sales, because companies don't go public just because they decide to go public. There's an actual legitimate reason to go into the public markets, right? So the stock market only really exists for one reason. It don't exist for any other reason. So if I'm Ford, right, what I'm really doing is just because if you look at my ticker, right? So let's look at the Ford ticker real quick. Let's go over 1 year, right? We talked about before. 2022, it hit this peak. Like the rest of the market, is sold off. So let's say from here, which is the fourth month of 2022, to where we're at now, we've been in between a $11 and let's say $17.50 range. So what is that telling me? There is no appreciation in stock price. We're just very much range bound. So how am I attracting new capital? Right? Because if I'm a growth ticker, I attract new capital because why? I continue to do capital raises and stock raises at higher and higher prices, right? But if I'm a range bound ticker, I can do a raise, I can do a block sale, things of that nature, but it's not at a higher and higher equity price because we're just very much in a range. So the way I got to bring new money into the company is I just got to do sales. Well, if you look at a company like Rivian, how is Rivian going to bring in new capital? Most likely they're going to have to do an equity raise, because I doubt they can do a bond because they don't have the revenue to pay the bond back. I doubt they can do a senior offer because most senior debt is done based on collateral. Well, what collateral do they have? Ford does probably have collateral, so they maybe can't do a senior debt, a senior offer, they're going to use a collateral to actually underpin the offer. They maybe can do that. But where's Ford going to most likely attract new capital? They're probably going to have to drive sales, right? Based on where they're currently at in the life of this particular company, right? Because we're already at so many billion shares. It wouldn't hurt them to add another 200 million shares there. And I don't think the dilution effect would be too bad. But I don't think, to me, that would be as powerful as trying to figure out how to drive some more sales. I just think that would be the easiest way to solve that problem. Because if we do an offer, where will we get it at? Will we get it at the market, or will we get it at under market price? So these are the kind of questions you want to ask yourself. So when you're looking at stable companies, how are they bringing new capital into the company? Most of the times, they have to probably drive new sales, right? This is how they're going to do it. With early stage companies, they can normally do an equity raise, normally through selling some more shares, or maybe if they're lucky, they can do a bond. But most people that don't have revenue can't do a bond offer, because how do you pay back the yield if you don't have the revenue? So these are the kind of questions you want to ask, because what I don't want to do is get surprised, right? with, oh, well, we were trading in this range and I'm bullish on it. And then what we did is we're going to do an equity raise, which means we're going to dilute our current shareholders. And we're doing an equity raise at lower than the current price, which means what? We're going to cause a sell-off. So these are the kind of questions we want to ask when I'm looking at a company. Where are they at in their stage? And then how are they going to attract new capital? With Ford, in my opinion, most likely they're going to just keep driving sales. Right? I doubt they can do an equity raise. They can do an equity raise, but it probably won't be an at-the-market equity raise. It'll probably be lower than the market price of the shares at that current date. And it definitely won't be at a higher price. Why would you pay $17.50 for Ford on a block sale if I can just go directly in the market and get it for $11.40? It don't make a lot of sense, right? So then based on all of that, what is my narrative on the company this year? So once I figure all of that out, right, and answer all those questions, right, and I try to do it with a level of being impartial. What I mean by that is that I don't like, let me be real with you. The only company that I have any kind of like a sentimental value from is I think it's a church-based nonprofit. They may not be a nonprofit, called Salvation Army. That's like the only business, maybe like food banks and maybe like Metropolitan Ministries, as far as actual like companies. I'm not talking about like organizations and movements and stuff. I'm talking about like companies, right? I'm a fan of the Salvation Army because I was a member of them when I was a child, and they provided a lot of really good experiences for me when I was real young. I volunteered at Metropolitan Ministries, which was I don't know what you want to call it, a church-based organization that helped women that was dealing with domestic violence to get back on their feet, and like food banks that help give food to people. Everything else, I don't care. I'm here to make money. Like, I just really don't care. So I don't have a emotional connection to any company. I'm here to make money. So I don't let that blind my view of the trade. Do I want to see companies go under? No, I was talking to my a family member the other day. I forgot the name of this particular company. Was going to have an Alzheimer's solution, right? Which is something that affects a lot of people, really don't have a cure for it. And I hope they find it. But I'm not a fan of them just because they're doing that. It just don't matter to me. I'm here to make money, right? So what I don't do is I don't let my emotion around something kind of blur my view of the company and the trade, because I don't care. I'm here to make money, right? I care about my business. I don't care about their business, because most of these companies I'm looking at, those people are exponentially in a better financial situation than me. So it don't matter what I think about them anyway, good or bad. They'll be all right when this whole thing burns down anyway. They got golden parachutes to hold 9 yards. It's the working people in the company that get impacted. The CEOs won't get impacted, right? They just don't care. So that's what I want people to really understand, is that I never let my personal feelings govern how I see a trade, because I really don't care about most publicly owned companies. I just don't. I don't have that. It's not who I am. I care about people. I really don't care about companies, right? So that's something I have to learn how to separate myself from, right? That deal, okay? Then I figure out what is my narrative on the company this year. So once I look at all of that around Ford, where do I think they're going this year, right? Where do I think they're going? And that's all I ask myself. Do I think they have the ability to hit their goals? Do I think they have the ability to compete in the space that they're competing with? Do I think that our national strategy as a country is going to help them or hurt them? What is their relationship with the current administration? So something that Katrina talked about, I think she said Biden is cool with Ford or something like that. I can't remember what I said. So Joe Biden likes Ford. And I really don't know if he likes Ford. I think he likes organized labor that's attached to Ford, which is very important. Right? I think he likes the organized labor that's attached to Ford. That's really important, right? In this country, right? Because Biden is a big fan. He got a lot of really good relationships with organized labor. In fact, he got way better relationships than Obama did, right? So that's important, okay? So that can color my narrative of the company. Now, I'm a fan of organized labor, but that don't mean I'm a fan of Ford. It means I'm a fan of organized labor, right? Don't have anything to do with Ford Motors, okay? So what's going to be my narrative based on me aggregating all that information, and then I'm going to come up with a narrative of where I think that company is going to go. Then I say, okay, after I do all that, and then when I'm coming up with my narrative, this is something I do. I say, let's say I create 3 narratives, right? One's bullish and 2 are bearish. Then I put a probability around each one. So let's say my bullish narrative is that based on what I think is going on in the world, yada, 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 I think there's a 40% chance this is going to happen. Then if that don't happen, what do I have now? I got a 60%. I got a 30% of one bearish narrative, and I got a 30% of another bearish narrative. So let's say hypothetically, my overall narrative is bullish. Then I have 2 other narratives that are bearish if these things don't happen, right? Because I always got to assume I could be 100% wrong about the situation, right? And so then that's always how I frame it, okay? Then what I start looking for now is I start looking at the trade. Now, the first thing I do when I'm looking at a chart, I'm looking at support and resistance. I'm looking at the 200-day moving average, and I'm looking at the 50-day moving average. Just off the top, that's the first thing I do. So let's go back to the yearly chart, right? I got the 200-day. I have the support day at around $11. The yellow line is a 200-day moving average, and the purple line is the whatchamacallit, the 50-day moving average. That's all I'm really looking at. And I'm trying to figure out, is this above or under my moving average? So let me zoom in a little bit, right? So what I'm seeing currently forward right now is under the 200-day. They're under the 50. They hit that 200-day and they sold off really hard, right? Make sure we're looking at forward. Okay, we're looking at forward. So I'm looking at the yearly 200-day moving average in the yellow, 50-day in the purple. What am I seeing? We hit that 200-day moving average. We sold off really hard. And we've hit that 200-day moving average multiple times. And we sold off really aggressively off that 200-day moving average. But we're also under that 50. And I have like $11 as a resistance. So what I would start doing now, $11 as a support. What I would start doing now is plotting out other resistance levels. Like, what do I think the resistance level is? It might be here like around $14. Then I can find another one here like at around maybe the 16. Then I have another here around 1750. And what I'm going to try to do is figure out, let's say on the yearly chart, what are all my support and resistance levels that I think I see? Just so I can know what ranges I think Ford is trading. Because one thing, if you look at Ford, it just trades in a range. And it'll collapse in that range and then get back to it, trade in that range, collapse, get back to it. And that's really how it trades. And then I would start asking myself, what is happening in the market that's making it trade like that? Then what is the current market condition? Right now, in my opinion, we're still in the bear market. I haven't seen any evidence that we're not in the bear market because of what's going on in the overall market, right? I have not seen any evidence as of yet that we're not still in the bear market. So we could be still, let me look at something real quick on the SPY. We may be green for the month, right? We may be green for the month. Let me see. We may be green for the month. Looks like we may not be green for the month. Hold on one second. We may, because so we're green for the month, but in my opinion, we're still in the bear market. Just what happened over the past year, right? Year to date, we're still green because it started in January. So we're green for the month, but I'm still looking at this like we're still in the bear market because we're not really through this month yet, right? Over the 5 days, we're red, and over the daily, we're red. But so I'm still seeing this that we're in a bear market, right? And I'm going to see this that we're in the bear market until I see, based on price action, not in the market, right? We still have probably a 0.25 raise from the Fed in, I want to say, February. As that liquidity continues to get pulled out of the market, the question is, how does the consumer respond to that? So my current market condition is that we're still bearish until I see monetary policy move in another direction, or until I see price action move in another direction. I'm not trying to anticipate a pivot. I don't do that, right? Because I don't see any indication there's going to be a pivot. Unemployment numbers came in today very low, right? Well under estimates, which means that there's still a lot of people that are working, which is good for them, but it's bad for monetary policy. So what is the current macro condition? Because of current macro condition and the liquidity in the market, most importantly, is going to impact everything because the Fed over the past year has been pulling money out of the market. And when you understand how the market actually functions, the whole market is run based on, what did I talk about at the top of the video? I talked about liquidity. This whole market's based on liquidity. It's not based on anything else. So as liquidity continues to get pulled out of the market because of what the Fed is doing, it's going to impact a lot of these companies' trading behavior. And I want to continue to find out, how do I think that's going to act, right? So from my standpoint, we're still in a bear market. What catalysts are coming in the next 30 to 90 days? This is something I teach in the course. What are the catalysts that are coming, I think, right? When I say catalysts, I mean, what are things I think can move the stock price? Earnings reports. They got earnings coming up in the next few weeks. Reports, any reports. I seen an article that Ford was going to build something. I forgot in what state. I forgot what state it was. And it got blocked because the guy said something about it's going to be used for the Chinese Communist Party is going to be utilizing it. It was like a weird story, but it was a legit story. But I forgot where it's at, right? So that might be something that's news related, like a report. What's some bad news I think is going to come out? What's some good news I think is going to come out? So over the next, if I'm looking at a trade on this currently today, over the next 30 to 90 days, what is some of the news that's going to come out around Ford, right? That could impact the price action around Ford, okay? That's what I'm going to look at. So here's a scenario, right? So I was talking to this about somebody yesterday, right? So we believe that Ford's going to report a drawdown, which means that they're going to report a loss of money next week. Probably next week, they're going to report it. And historically, when they report this drawdown, it's created selling in the stock. So what we've done is we have located the other times during the history of this company where they have reported this drawdown. And what we've seen on the chart is when they report the drawdown, it sells off. Now, you can correlate that to the overall market. You can correlate that to whatever the monetary policy is. However deep you want to get with that, you can do that. But what we've seen from a two-dimensional standpoint is we believe we have a correlation between reporting this drawdown and the sell-off. Now, the sell-off, I can't tell you right now whether or not the sell-off is under that support level, but a sell-off from wherever the current price level is at that time, people now decide that that particular price is too expensive based on the news of that drawdown. And we believe that's the positive correlation. So we now believe that could be our edge in the market for a trade, right? So what we do now is say, do I want to get ahead of the play, or do I want to wait for this to happen and then play it? So these are questions you got to ask yourself as a trader, right? That I ask myself. If I'm looking at a play, do I think that I have so much conviction around how the market's going to respond to this news, I want to be ahead of it? Or do I wait for it to happen, and then once it actually gets reported, then I play it then? And you have to decide that on yourself, right? Based on your risk analysis, your contracts, your psychological makeup, your account, how you decide to manage capital as a capital manager, that's something that you got to decide. I've made a lot of money being ahead of plays, and I've lost money doing that too, because you're not going to always be right. And often you can be early, and in this market, being early means you're wrong. That's just how it goes. But you can wait for it to happen. And because we're trading at the moment, IV can go up because, like I said, let's say the report comes out at 5 o'clock in the morning, the market makers go in there, they manipulate their algorithms to where as soon as the market opens, options contracts, IV starts to spike because they start to price in the perceived movement of that ticker based on that, which means you're paying more money for the ticker to get into the door than if you don't get the movement, right? Let's say it trades flat, and I've seen companies come out and trade flat, even though they gap down, they don't keep selling, they gap down and trade flat the rest of the day, right? So it gaps down, but it trades flat, which means what? You get an IV crush, because what you need is to continue to sell because you pay to increase IV at the open. I didn't. I was already in the play a week early. So as soon as the market opened up and it gapped down, I just sold my contracts and I got out. But there's a risk on both sides. So you got to determine, do you want to be ahead of the play, or do you don't want to wait for it to happen, then play it, right? Either way, there's a risk you're taking, right? So these are kind of questions you got to ask yourself based on your setup, what works best for you, okay? So if I believe that this is going to happen, I believe next week they're going to issue out this report. Now, what do I know is going on in the current market right now? Right? So let's talk about it. So this is how I look at a trade. So what is tomorrow? Tomorrow's operations expiration. Well, a lot of monthly contracts are going to expire. Normally what that does, it creates a lot of volatility in the market. So if you're in the VIP course, I have a actual class on monthly options expiration. And I encourage you over a 12-month period, I always encourage you to find the monthly options expiration. So if you didn't take the VIP, you got a lot of really good information for free just by watching this video at the 55-minute mark, right? Why do we do that? Because around that date, you get a lot of volatility. Because why? The option sellers don't want to pay out. So a lot of times they look at what direction is the market in, they swing the market in the opposite direction to kill all the premiums, right? So they ain't got to pay it. Okay. So you always got to anticipate. One of the ways in which I knew we were in a bear market, this might have happened, I want to say maybe May, because they used to say sell in May and go away. It might have been May or June of last year. And we was in a monthly options expiration. And we have been bearish the whole week. And that Friday we opened up and they sold that market so hard. I said, they're not playing. Because they had to pay out all those puts. But the bears were so aggressive that day. That's how I knew that we really was in a bear market. Because I say these people not playing. Because everybody knew, we know when the date is. So you know, as we go into this date, you look for a lot of volatility. And normally they try to swing in the opposite direction of what the majority of the market is holding. And they know who has the majority of positions. You can't hide this stuff because it's all electronic. So they know who's holding all the positions. So that's something you always want to look out for. So I'm looking at this trade with Ford. I know, say, hey, I believe they're going to report this next week, but I know we're going into a monthly options expiration. So it can create a lot of volatility, right? So do I wait until next week to buy the contract on Monday? Or do I try to maybe look to buy the contract right before they close on Friday? Because most of the volatility will be gone, right, out of the market by Friday. You know, I'm talking about looking at buy the contract like maybe 5 minutes before the market closes. Because I may be worried that if they report it on Monday at 5 o'clock in the morning, what did I talk about? The market opens up. Let's say we happen to be bearish. The overall market is bearish. Then Ford comes out with the bad news. The market maker spike the premiums. I go in and buy it. What I need is a continued sell-off for me to make money, right? So these are the kind of questions you got to ask yourself. So does it make sense for me to buy Friday with an anticipation that they're going to report next week, or for me to wait for it to come out for me to buy? Because I know this is an option expiration week. Tomorrow is the OPEX it's the 20th. And I have these plotted out for every month of the year. And I pay attention to this, right? So let's say, hypothetically, let's say I'm a buy tomorrow. I looked about like at 3:55 Eastern Standard, because I figure most of the volatility has been out of the market by the end. They're getting ready to close the market, take the weekend in. So then I start looking for contracts. Now, there's something else you got to factor in. When is going to be their earnings, right? Because I may be able to get a double dip on the play. Well, what do I mean by that? If they report bad news, right? So their earnings is the second, which is like 3 weeks away. So let's look at this options chain. If they report bad news on the drawdown, and I don't think they're going to hit their earnings, because we saw their earnings is higher than it was last quarter, right? So do I believe they can hit their earnings? Or even if they hit it, a lot of these car companies have been communicating that there's a lot of stress in the car buying market. Right. I had a guy, and y'all might know him. I was talking to him with a student yesterday, a guy named Lucky out of Vegas. He's a major player in the used car space out of Vegas. Right. And he buys paper, which means he buys car loans. He's saying that a lot of the repos and the people not being able to pay their loan is not going to show up into this earnings, because it's going to be for 2022. Right. So CarMax didn't have a great earnings. For some reason, they haven't sold off yet. But CarMax did not have a great earnings, and they talked about a lot of stress in the market, right? I don't know how Ford is constructed. Like I said, I got to do my research, right? Does Ford manage some of the financing around their cars? Are they going to anticipate that the market is going to be softer on earnings guidance, because we may be going into a recession. You see a lot of firing as opposed, because a lot of companies feel like revenues are going to be softer these next few quarters than what they've been historically. Do they also believe that? Because I could get a double dip where I could get a hit on that and I could get a sell-off because of a bad guidance. So if they miss earnings and they got down, it could create a sell-off. If they hit earnings, but they got down for the next quarter, the next 2 quarters, even they got down for the year, or they issue no guidance, they also could sell off. So when looking at my contracts based on my account size, the amount of risk I want to take, I look at what expiration date am I looking at, right? Because if I just want to play it for a short term, I may look at a weekly, maybe a 2-week play. Or if I want to play it for a lot longer term, I say, well, let me maybe look at contracts that maybe expire after earnings, but still it's going to be dependent upon open interest on the contract. So here's something I will look at. So we said the second is when they report. So let's first look at maybe the 10th, right? So I'm looking at puts on the 10th, right? So I have the 1250 at 3,000. I have the 12 at 918, 980 volume on the day. And I have that 1150 at 1200, 314 on the day. So those might be decent contracts. But here's the question. I got the 12, the 11, the 11, and $11, right? But the question is, let me open up this chart in the new tab real quick. Looking at those contracts, because the thing about Ford, it's real range bound with a real strong support level. So what I will be worried about is once we get around this $11 level, it normally gets bought into. So I would maybe look to buy the 13 or the 12, and I would not really believe it's going to go under the 11 till it showed me it would, because I'm seeing a really strong $11 support all the way through. So I think it may take something catastrophic to get this thing to start not being bought at that price, because I'm just seeing a really strong support at around this $11 mark, really between like 11 and 11.50. So currently right now, we're trading at 12.18. I would look to buy, if I was going to buy it, at around 12, what we're looking at, the 12.50 or maybe the $13, and try to figure out, would that be worth it if I could get a big enough drop? Now, one of the things you can do with a lot of these brokerages now is they can tell you where your break even is at. And they can tell you what is the break even on the stock price for that particular contract to be profitable based on the current conditions of that contract at that time. Because my biggest challenge with this ticker is it's so range bound. What I would really want it to do, and really why I should have called it, I really should have called it, excuse me, I really should have called it around the $13 at 13.43. Because what do we see at the 13? Let me zoom in a little bit more. It hit the 200-day and it just collapsed, right? It hit the 13-day and then it gapped down and then it continued to sell down. So this is really why I should have called it at. But like I said, I didn't know about, this was on the 12th. So this was last week. I may not have known about that report getting ready to come out. But if I knew that that report was going to come out on a certain date, and I knew about that 200-day moving average that it keeps rejecting, we look at it, it keeps rejecting that 200-day moving average, I'd have been looking for a combination of both of those, right? I'd have been looking for a combination of both of those as it gets closer to that 200-day moving average. If I believe it's going to reject that 200-day moving average, which is done historically pretty much over the past year, and I know that bad report is coming out, and I think they may guide down on earnings, then I would be looking for contracts. So let's say I would buy this on the 12th for contracts to maybe potentially expire. I don't know why I'm doing that when I got it right here. I would be looking for contracts that maybe potentially expire after earnings, right? And I just would keep looking at this options chain. Like, what do I think is a good contract for me to buy based on my budget to expire, right? So all I see now is maybe those Februaries. We got some in March. And here's something I think, I don't know if I talked about this before. This March 17th, with this 11,000 volume. And I want to say, I don't know whether or not, if I was talking about this with the person I was talking about yesterday, did that open interest go up? Did it get carried on to the next day? But one thing about this contract, it's doing a lot of volume on this contract. And I'm trying to figure out why for this March 17th, 2023. Why are we doing 11,000 volume on one day? So that means they're trading in and out of this position. My problem is I don't like this strike price because what do I see with Ford? It normally gets bought up at around $11. However, if I buy in there and we get a gap down to the 11, let's say I buy in at 40, it may go to 55, 60 and I exit. But this is curious. Now it's up 14% on the day. Why we're getting so much volume, and I believe this open interest increased from yesterday. Why we're getting so much volume on this one ticker at this particular strike, even though this is right at support. So my question would be, does somebody know something that I don't know? And that's the reason why they're trading in and out of that position at that $11 strike, right? But that's the question I would ask. What I don't like about this ticker is I wanted to push way harder off that $11. I wish I could have caught it here, right? But I don't, like I said, I don't trade this on a regular basis. I wish I could have caught it at around here, right? Because see how it keeps bouncing off there. It just keeps bouncing off that 200. So I'd have been looking at it to catch it around here. Because every time it gets close to that 200, it keeps selling off. And even as the 200 goes down, because it keeps adjusting itself, it doesn't want to have anything to do with the 200-day moving average. And now it's also under the 50, right? So I would have wanted to catch it around here, but I don't know why it got bought in. I would assume it would get bought in here, but this is a really, really strong move. But you see it hit that 200 and stalled right back out. So me knowing the company, I could have come up with a narrative of why I did this, because that's how I could play it on both sides, but I would have to really know the ticker. But I wish I could have caught it around here and then be in the puts right now in anticipation of this particular news that I think is going to come out next week, right? And then once the news comes out, I just exit. And then I look to maybe reposition around or right after earnings, right? And so this is how I would look at the ticker. But another thing you can do, and you don't have to, I don't want people to think you have to, because it's a paid service, right? So the difference between me and a lot of people is I will go to Yahoo or Webull or whoever, and I will literally look at every contract on this chain. I just will, because that's how stuff like this jumps out, right? So I will go through every contract on the chain. It don't bother me to look at it, because to me, the money's in the research. It's kind of like people that are, you watch like the lawyer shows. So what's exciting to the audience? The courtroom stuff. But the real work is done in that law library. That's where the real work is. That's how they really put your case together. That's why guys go to the Fed and they spend all their time in the law library trying to get their appeal together, because they realize that's where the real work, because a lot of times the work's not done in the courtroom. You often don't even want to take a case to court because it just costs a lot of money, right? So you want to try to construct something to where you don't have to go to court. You can get a plea or something of that nature, and you don't have to go to court. So the real work is done in a law library. A lot of my real work is done on the research side. It's really not done trading, right? It's just really not. But that's the side people see. A lot of my work is done way before I ever make the trade, right? I'm already coming in with a narrative and a contingency plan and how I think it's going to go, yada, yada, yada. And then I just see how it plays out in the actual market. So I'll just go look at the options chain, and I'll look at literally every strike on the chain just to see what's there. But something else you can use that you don't have to, and it's not a cheat code, it's just an aggregator, is something called unusual whales. So I pay them like $40 a month for this information. And what they do is they just aggregate the chain. And so what it can help me is that I can go to something called the intraday analyst, and I can look up, right, what's the most active chains. So the $12 put that expires tomorrow got 18,000 volume on it for 11 cents was the high, 4 cents was the low. I get to change with the highest open interest, right? So it can help me. And there's that chain we were looking. No, that's not the chain. That's 120, my bad. So I get to change with the highest open interest. And then I get the biggest options change. Like, what are some of the biggest buys at that particular time, right? But all of this information is inside your brokerage account. It's just they aggregated to where it's in the graphics, it's in colors, it stands out, yada, yada, yada. And I can see, which is helpful for me, whether we're on the ask or the bid side, right? But this is not something that is essential. It's just an information aggregator that I use because it helps aggregate a lot of information for me. But if you can't trade and you don't understand the market, it's not going to help you, right? It'll just be like a toy, but it won't be really beneficial to you. So this is how I would look at forward. So you see that the majority of the work, right? If we go back through it, the majority of the work when we're going through all of this, all happens before I ever look at the options chain. So this, that, all of that. It happens before I ever look at the options chain. Then now I'm starting to ready to look at the option chain. And so this is how I've been able to be successful as a trader. So is there a technical analysis in it? Yes, a lot of technical analysis, but I don't just look at charts because I'm looking at a company that actually has to do sales. So to me, I would rather know, let's like Netflix is doing their earnings today. I would rather know what's the health of the company from a revenue standpoint than waiting for the chart to break down, right? Or like with Peloton, I knew that was a situational play way before the chart broke down because I know fitness, and I know just because everybody bought the bike because of the pandemic, it don't mean they're going to buy the bike when the pandemic was over, right? So their sales is going to drop off. They are another company. They once they were no longer in the growth stage, they fell off a cliff because once I don't have to work out at the home, what am I buying the bike for? Right? Because the real business is in the health club space, right? So these are the things I'm looking at on the trade, and I pretty much will repeat this for every ticker I look at, right? And I say the majority of the work is done on the research side before I ever make a trade, right? And the first thing I look at is 2 year, 5 year, 1 year, which is from Lance, who's also in the VIP. She taught me that, the long-term view, the medium-term view, the short-term view. And then I look at the options chain because if there's nothing on the options chain, I can't make a trade on it anyway, right? Because I don't short sell at this moment, right? So that's the first thing. So none of that matches up. It don't make sense to do, all that research. And you may say, well, this is a lot of work. It is when you start, but as you get more and more experience, you start to have the ability to do it in less and less time. Like with anything in life, once you get used to it, you develop a routine, you can do it in a lot less time. So now I can just look at a chart and I can see the support and resistance. So Chastity can look at the SPY and see stuff in the SPY that I can't see. Why? She's been doing it longer than me. I'm still learning from her that stuff. So I look at the SPY. I don't see what she see. Why? Because I ain't been doing it as long as her. I'm not as good as her. I'm still learning. So I know it's a process. It ain't going to happen overnight, right? But when I'm looking at a ticker, just an individual ticker, especially if I know the ticker, I can look at that thing and immediately see this is support, this is resistance. I can tell you that, you're looking at Avis, the buyer's going to come in at 150 because that's where the buyers are at. They got it set to buy in. So what I'm looking for to do is a collapse under 150. But the buyers have been coming in for Avis at 150 for the past year and a half. What we're trying to see is that when they do this next earnings report, is it going to collapse under the 150? Because I believe at 150 is still overpriced based on what I think their future revenues are going to be. You see what I'm saying? So I can immediately look at that chart and tell you what the support level is. So I know where not to buy an options contract at because I know what the support level is because I looked at that chart so much over the past year and a half because I was wrong on that play. I thought that would collapse under 100. Now I think it closed the day at 180. You could have never told me that ticker would be at 180 in January 2023. For a used car company, you got to be crazy. Now let's say selling Lamborghinis. That don't make no sense. So that's pretty much it, right? So hour 14, like I said, as you do this more and more, you'll start to compress your time. And as you learn the company more and more, and as you learn that space. So if you learn forward, that now relates to pretty much every company in the space. And I don't mean it's not going to be a direct correlation, but once you learn the car space, you know the car space. If you're looking at the home builders, once you learn DR Horton, you know pretty much how to look at the rest of the companies in the space. If you want to get into the pharmaceutical space, once you look at one drug maker, you know how to look at other drug makers. If you look at a computer hardware company, once you look at one, you know how to look at the other because they're all in the same industry. So they're being a lot of times evaluated based on the same metrics. Now, Tesla was an anomaly in the car space because they're trying to evaluate it as an energy company. I don't agree with that because they're not doing energy sales like that. Most of their sales are from cars. But we're seeing now that they're being valued more as a car manufacturer as opposed to those other ancillary things. Like you can't value SpaceX because it's a privately owned company. So I can't value that in Tesla. But that's what they was doing for a long time. But I'll do it if Elon says if you buy Tesla shares, you get a piece of SpaceX. I'll be one of the biggest buyers of Tesla in the world because I think SpaceX got way more value than Tesla because he's going to be able to get government contracts for SpaceX. Right? So if he makes that all part of the deal, to me, that's the deal of the century. But he's not doing that because he knows he could take SpaceX public and probably get a bigger valuation for SpaceX than he get for Tesla. I think that's his trump card. See, he's not going to tell nobody that. That's going to come out later. So we're going to go through these questions. We're going to go get up on out of here because I think I got a 7 o'clock live stream. So we got any questions, let me know before we bounce. So Raygun, man, I appreciate the $2, man. What's up to Decatur, Georgia, man? East side. Well, I'm going to say, I'm going to be in College Park later this month. I ain't been out there in a minute. I used to be over there in Tucker, real heavy. Terrence, man, appreciate the $4.99. What's going on? Alonzo, the all-star advisor. Katrina, what's going on? Kay, what's going on? Miss Phoenix 91, what's going on from Toledo, Ohio? Yeah. Does a lot of volume. Ford does a massive amount of volume. So Katrina says, look at the volatility in the earnings estimates. Okay, I need to do that. What's going on, Ty? Yeah, you're right. So she said Seeking Alpha normally has the written earnings transcript. So that may help some people. If you don't want to spend the time listening to it, it may just help. If you get the written transcript, you can just read it. So that is a big help. And that's free. They give out a lot of stuff just for the free. I don't do the paid version, but they get out a lot of really good information just on the free site, right? They got a really, really good site that's kind of slept on. So it's 15 cents share on the dividend. Okay. That's not bad. So Chazzy says, what range do you like the float to be in? So Dr. Chaz, it depends. That's all to me situational. One thing I know is that a smaller float, there's more volatility and I can get caught on the wrong side of the trade if I'm bearish. If I'm bullish, it's great because of what? As people start to buy in of it, it'll ramp up. So it's really situational, but most companies with real big floats, I would, and you got to always factor in float and market cap, right? So I could call something a big float, but the market cap could be so small, the float really might not be big. But let's just talk generally. Over, I would say 300-400 million, the volatility a lot of times, in my opinion, is not the same unless there's a big issue going on. But companies that are around maybe 250 to maybe 500, it's different, but it's still, to me, case-to-case scenario. But you start looking at them companies with like 20 million, 30 million, 40 million float, it can be dangerous because you don't get a lot of volume because it's rare to see a company, and I'm not saying this is an absolute, 20, 30 million, but maybe doing $1 million, $1.5 million a day in volume, right? Because it means they're turning over a lot of their float on the daily. Talking about day in, day in, day in, day out. So what I'm worried about is I take a short position because the float's so small, we get bullish activity, and then because everybody got a cover, we get not a short squeeze, but we get a short covering, which pushes the price up. I would want it on the bullish side, but I don't fall for. We got a small float. It's going to squeeze. So buy in, it's going to shoot up because that's going to happen if it's going to happen. But if you look at I want to say maybe November, September, October of last year, one of the reasons why CAR went from $100 to $300 in the first hour is because they were trading at around 30 million shares and everybody had the short cover. It was a short cover. So in about an hour, hour and a half, it went from 100 to maybe 300. I'm saying almost $400. You had contracts that maybe was $1,500 at the open. They cashed out at around $100,000. Now that's, can you get out of the play? But that was a value when the ticker goes from $100 to $400 in an hour and a half. You can, that's a lifetime play right there. But you just had to be on the right side of it. But it was because it was around 30% short on the float, and it was only around 25 million to 30 million shares available to be traded. So once they had to cover, they had to pay whatever price they had to pay to cover, and they just got punished in that play, right? So that's the danger of that small float. But like, Apple, Ford, some other companies with those built, Coca-Cola, a lot of times they just slow movers, right? It's a really slow mover because it takes so much to move those shares, because you got to get such big buys. And, what looks big for Ford, what looks small for Ford is big for everybody else because of the amount of shares. Doing that much volume in a day is crazy. That thing's just churning because the market maker loves it. They get paid on all those transactions. So they love it. Okay, so Hey BB says 4% for a dividend. So if that's on the year, right, then I will go look at a 2-year treasury. What am I getting paid out on a year on a 2-year treasury? I'm getting paid 4%. Well, it make more sense to buy Ford then. Now, there's no guarantee Ford's going to pay out, but Ford's paying out greater than a 2-year treasury on the 1 year. See, so on the dividend side. So this is why I try to tell people, like, the idea that you should just index everything. Nobody can really sit down to me and have a really thorough conversation on how they come up with that. They could talk about historical returns, but anytime you're going into a fund, they'll tell you off the top that past performance is not an indicator of future performance. So that's not a guarantee. The treasury is a guarantee, but nothing else is a guarantee in the market. So most of the debt is from Ford Motor Credit side. Chassis says they did a price increase on current subscribers, but the newsroom was probably built in somebody's basement. Yeah, I feel you. I mean, I heard everybody's going to go to Teams, so we see how that goes. Katrina says Zoom is done because Google Meet is free. Yeah, I feel you. Yeah, I was on Zoom when they first started. To me, it's like Skype. Now their balance sheet is superior. They got a hell of a balance sheet. So they're running a really well-managed company. But they're Skype. But Microsoft played themselves on Skype. So Urban Homestead says the firm have a long-term viability thesis given the move to EVs and so as well. I don't know. I have to do the study. I have to get into that what their actual narrative is. I don't buy Ford, so it don't matter what they make. I'm not gonna buy Ford. I don't buy Fords. I buy Asian cars. That's just me. Everybody different, right? They probably couldn't give me a Ford. I've seen Tesla prices going down. I wonder what Hertz is doing with all those Teslas. We got to see on earnings what's going to happen. They're going to have a powerful earnings. Mr. G, I appreciate the $20 super chat. So I'm using early in my short plays, and I go out 6-month play using options, giving yourself theta and the purchasing the money, give yourself a chance. Yeah. And I'll be early in some of my short plays too. So you're not the only one. That's one of the things about being an options trader. So where I may eventually investigate, Mr. G, is I may investigate short selling, but there's a lot of risk with short selling because we know your losses can be undefined. So if we're short on the play, we don't have to worry about being early, but our losses can be unlimited because if we get squeezed, we could go from having to cover, at 5,000% higher than what we bought in at, than what we sold at. I'm sorry. So, either way, it's a gamble. One thing about the options market, you're defined at how much you're going to lose. But yeah, I've been early on plays too. So you're not the only one, so it's just something we got to weigh out. But in any market being early, we could be early on the real estate market and not make money and then sell out. And then 2 years later, that market blows up. As I was watching a guy on Erica's video, he was talking about people buying lots in Sarasota for, I want to say $1,500. Those lots now are $20,000. The person that sold those lots for $1,500 is probably like, why did I sell that lot for $1,500? But they probably have been sitting on those lots for years and not making no money. But now Sarasota in Florida is one of the hottest real estate markets in Florida. And I remember when nobody didn't want to be in Sarasota, it was the sticks. You know, so that's how markets work. Yeah, Lucky Lopez. Yeah, he got a good channel. So Terrence, man, I appreciate the $50 super chat. So appreciate everything you do. Ford is one of my top tickers. It's dope seeing how you break things down. Okay, I'm glad you get some value from it. So Noper says you don't even trade, but this is diamonds. All right, I appreciate it. So Katrina says this also works for investments. So AT&T is a banger. I ain't looked at AT&T. I need to look at. I was looking at Nokia a minute. So how do I feel about commodities? I haven't really looked at them, to be real with you. I've been looking at energy. That's the only commodity I've been looking at. I haven't really looked at wheat, corn, and silver. I've been looking more at oil, to be real with you, right? So I'm trying to figure out how does oil get impacted or energy get impacted if China opens all the way up, because they're going to put a lot of demand on energy. So my bullish and bearish on the next unemployment look. The third, I'm still bearish on the overall market till I see something different, right? I think they want to see more people unemployed. Yeah, I used to trade FCX. Yeah, you're right. You sure do. You know, because I saw those people get forced out of Avis. I was like, man, them people getting punished. So let's see how it goes. Yeah, you're right. You got to have real good stops. You got to kind of, because what I'm worried about is also borrow rates. You know, so but that's the issue. So I may start looking to short sell, because I could have made a lot more money on Carvana if I was selling it short. I know a guy that was selling it short for like $250,000. He made like $1 million last year just off Carvana. But he knows how to short sell real well. So it may be something I start looking into, right? Because I could have made a lot more money on Carvana by selling it short, right? Because that play was a no-brainer. And that thing went out. I didn't think it was going to go into $10. It's like at $7 now. So Dennis says the market's faking out bullish side. I feel you. So that's pretty much going to be it. Appreciate everybody for coming through. Definitely appreciate the super chats. So that supported the time we had to put into the platform. Just want to tell everybody, make sure you manage your risk and let me know if you're in the course. If you got any questions, make sure you reach out to me. You know, let me know what's going on with you, and let's just keep pushing. And everybody stay focused on their goals and cut the distractions out. And I'm very confident that we can get success. Y'all be easy, man. Be safe. Talk to y'all later.